Welcome to Curious Futurist. Today on the show, we're talking about green finance, also known as impact investing, and the whole world of sustainability innovation. What do these terms actually mean? Is there a green revolution in finance just around the corner? And what are the implications for your career, your lifestyle, and maybe even your investments? Joining me is this week's guest, Nicole Anderson, the CEO and managing partner of Redsand Ventures. Nicole has years of experience in this field, and she'll be explaining how the world of finance is changing and becoming greener, as well as what that means for us all. Stay tuned to find out more after this. Hi Nicole, thanks for joining us today. How are you?
Thanks, Damien. I'm very well. Great to be with you again.
Great. So you're the managing partner of a company called Redsand Ventures. Can you tell us about the company and what it does?
Redsand Ventures is in the intersection of sustainability and fintech innovation. We have been looking at innovative business models in financial services for almost 10 years now. And in the last 18 months to 2 years, we focused almost entirely on the green agenda. So predominantly where the world of the environmental biodiversity challenge puts financial services. And our response to that is actually looking at sourcing innovation for clients, but also building ventures ourselves and investing in third-party innovation. So we're pretty much a one-stop shop when it comes to thinking about fintech and the future, a greener future. We call it, building and investing in ventures for a greener future.
Okay, one of the ways you talk about this on your website, I've noticed, is very specifically sustainability innovation. Mm-hmm. So we could talk about sort of green tech or sort of green fintech. We could talk about sustainability innovation. I mean, what's the best way of trying to define that for people who aren't familiar with it or have just a vague idea? How do you define it to people?
Yeah, I mean, it does require definition because sustainability means so many different things. It is obviously a very popular phrase and is interpreted in so many different ways. But from the perspective of our world, we are looking at the sustainability of financial services, the products and the services that flow into the market in order to, number one, elevate poverty, increase financial inclusion, and protect our natural resources. And so for many a listener, the real kind of core connection or immediate connection with financial services is not that obvious. But really, if you think about it, money and investment fuels our economies. And so it is, when you just think about it, even just knee deep, super important for financial services to be not only abreast with the consequences of where they put money and how they evaluate risk, but also how they really are ahead of the market to provide future generations with the ability to prosper in a responsible and a sustainable way.
Where's the pressure for this coming from? So, because you've said just now it's something like in the last really 18 months to 2 years kind of thing, you've really started to focus on this. Is this something that there's a clear demand for in the market? Is it more that there's external pressure from, say, regulators or government bodies or so on? Or is it like even public pressure to do something about sort of more social inclusion and about more environmentally sound kind of business practices? Where do you see the pressure coming from for this, for change?
The pressure has changed, Damien. Certainly, the idea of sustainability and sustainable economic development has been a topic that has been very common in and amongst policymakers going back now since 1994 with thanks to the UN. The Kyoto Agreement, some of your listeners may be familiar with that was signed, not by every country in the world, but some major players, some major economic influences in 2003, I beg your pardon. But really the Paris Agreement, which was an agreement signed in 2015, was the big trigger for change. And that really the emphasis for the Paris Agreement was to ensure that the world and the major corporations and the backers of those corporations, i.e. institutions and underwriters, did everything they could to ensure that we transition to a greener future, which in measurement terms meant we needed to keep world global temperatures below an increase of 2 degrees, right? So that was the kind of big KPI that the world was working towards. What we've seen in the last 2 years is that filtering through into a myriad of different associations globally, and a number of policy structures and frameworks coming through in order to service and guide, more than anything, guide and educate financial services. But it's really only 2020, for probably the most obvious reasons, that the word sustainability has been really grounded in the role of financial services. And by that, I mean, what we saw probably 2 months ago, actually it was July, we had the EU release the first ever harmonious framework for sustainable investing. So it's a taxonomy. It was a UN sustainable finance taxonomy that came out to actually help really structure in the minds of big investors how they evaluate in a consistent way what is a green investment. So huge, big tick in the box for the European Union. And of course, this pandemic, for everything that it is, represents the largest use case of systemic risk the world has ever seen. And whilst the effects of the pandemic have a long way to go and work its way through financial markets, what we are seeing is, of course, the real economy, people like you and I begin to actually correlate the effect of the natural world having very dire consequences on our micro and macro economies and society at large. So I think, 2020 will go down in history as the great awakening for sustainability. If there was any doubt that this was important, this year has proved out how important it is. I mean, it is all important.
But there's a lot of information there to process. I would say the first interesting thing that strikes me out of that is evaluating what is a green investment. So how does a company or institutional investor go about evaluating now what a green investment is?
Yep.
Yeah, I mean,
So,
how do you do that?
I'm nodding because you're actually asking probably the biggest, most sticky, tough subject and topic and question that the investment community globally is challenged with. So there are a few things to consider. First of all, as I had mentioned previously, there has not been a consistent way for the investment community to define what a green investment should look like and continue to look like up until this year. And by the way, this framework has come out of the European Union, but is certainly not something that is pervasive. North America is beginning to look at a similar framework, but what we hope is that these frameworks, if they pop up around the world, actually do correlate. Otherwise, that gives us the same problem all over again. So that's the one thing. The other thing is being able to assess what a green investment is really has a very strong correlation to what impact that activity, that operation, that investee, that investment has, either on society, communities, or the environment. And we know, I'm sure you've taken out a mortgage, you've taken out your premium with an insurer. It's a very one-dimensional transaction. You get your money, you hardly speak to your provider ever again. And that is exactly the same, or has been exactly the same case in public and private markets where investors are making investors. The the need to monitor an investment has never been there. So there is a huge amount of work going on within the investment community to, first of all, understand the technical natures of how they assess risk right up front, so investment risk. And that's calling on different skills, capability, a different level of education, and so how they allocate capital needs to be looked at as a basically a first stage in assessing what a green investment is. So there's technical knowledge required there of the sector or the industry they're going into. And then they have to, in order to meet all the responsible investing criteria that a number of kind of policy pressures placing on them, force through that those investments stay true to being green, right? So I'm sure you've heard of the term greenwashing. Very often that is a time-bound activity. You know, it's easy to kind of trick a source of funding or an underwriter in a first exchange, but if that behavior is not something that is systemic in an operation of someone receiving money or being protected through a policy, then actually that is not a green activity. So this term monitoring, you know, is used very as a very common term in financial services circles. So being able to invest in the ongoing evaluation year on year of where that capital is going or continues to go is super important. So all of these things come together in assessing what is a green investment, or an asset which has an important role to play in the greening of our future, but has some risk.
Wow. So I guess mindset here might be a challenge for companies.
Well, hugely so. I mean, you have, first of all, a massive, less so you can imagine with the new emerging market makers. So whether you take, if we just take some of the kind of key transitional industries that represent the biggest opportunity for change, but also the biggest risk, right, to a greener future. So transportation, logistics, construction, very, very bad, culprit when you consider building and the nature of building and certainly the digitization of buildings, big emission challenge. But then food supply, anything to do with large supply chains. These are massive industries. The financial markets rely on these industries. We rely on these industries to keep going, right? But we have to transition these industries. So what is required from the stakeholders, i.e. the players in these industries, is more and more disclosure. And that is unlikely to come without pressure. I've just been in Greece about a week and a half ago for a number of different tasks and activities. But one of the things I was looking at was the shipping industry and the role of ocean preservation as it pertains to the stakeholders in shipping. It was pretty much a mixed bag as to how proactive the shipping industry, certainly within the context of that part of the world, will be in the short term to changing. There's very little impetus for change. The change is going to have to come from those that are providing capital to the industry, government and regulators in certain corridors, and of course those that underwrite the risk associated with the industry. So within the change has to come from the stakeholders, the players in these industries themselves, and the financial community. In what order? I think it's probably safe to say that it's probably likely to come from the outside in rather than the inside out, because the incentives are not there unless, they're very forward thinking. If you take new market makers, so you look at renewable energy players, or you look at disruptors in the area of, for example, sustainable construction, or new food producers. So let's take the example of vegan food producers, or clever ways in which, you know, supply chains can be disrupted or aided or accelerated, then of course there's less, they represent the new world order. The issue is the majority of the financial community is less familiar with these players, right? There's a technical understanding or a technical gap of how these new market players operate, the technology they use, the digital business models they use. So there's an education on the side of the financial services community to get to grips and really fuel this innovation. And a lot of this innovation is also fairly new in terms of maturity of businesses. So these are smaller businesses than as you'd expect, right? They're growth markets. And therefore they rely not so much on big walls of public institutional capital, but they rely on private investors. And that has its own challenge as well. So we can talk about private equity and venture capital, if you like, as another topic. So super interesting. You know, I think the pressure will come from a number of different places, different corners, but ultimately markets speak, and our voices as individuals are incredibly important, right? I mean, if we stop buying, or if we go and, you know, if we go on our activist trail, that all speaks. And that's likely to continue. It is growing, and that's a very encouraging fact.
Well, one of the things that interests me from this, I mean, lots of things, but one that strikes me now is the role of the institutional investors in this. Now, it seems that you can see some movement here where I think of AXA as an example. You know, by some measures, it's the largest insurance company in the world, depends how you measure it, but they seem to be committed, at least in what they say publicly, they seem to be committed to, for example, not underwriting or restricting the underwriting of, say, fossil fuel-based projects, energy projects and related projects. And also, so that's the underwriting. So without the underwriting, a project can't get built. And then the other one is that they seem to be moving away from investments in fossil fuel-based companies and projects as well. Do you see more of this? I mean, AXA is one that strikes me just because I know the insurance market a little, but I mean, do you see that there's a kind of trend here where institutional investors are moving in that direction, or is it just kind of, there are a few sort of key standouts?
No. There has been a move for a number of years. So for those of your listeners who are interested, there is an organization called Climate Action 100, which I guess, what it says in the tin is initially it started with the signatories of 100 corporations, both market players, you know, industries, and the financial services community supporting those industries, signing up to this transition. But that's grown. That's certainly grown. I think they're now over 1,000 signatories. So very large corporations. It's all in the public domain. You can go onto the website and you can check out who's playing, and access right up there. In fact,
I'll put a link actually in the description box. People can go straight to that if they want. Yeah.
So we are seeing that. I think last week we saw HSBC announce its strategy in terms of sustainability and what that means for the various parts of its operating model. But what you have, interestingly, is for the most part, the biggest losers and gainers are the institutional investors, and many insurers are asset managers, right? So there's a double whammy for them. They are suffering and hemorrhaging, and have done for a number of years. I think 2 years ago, the global insurance industry's losses were like the largest on record because of forest fires and terrible hurricane activity in the Caribbean and in East Coast of America. And this continues. I mean, just look at what's happened in California this summer. So big losses, but at the same time, they also having to put their capital to work, our premiums to work, and therefore are very, very challenged, right? So huge walls of capital have to be put to work, and where do they get return on that? And so they really are facing I think the biggest dilemma when we look at the institutional market. The next area under huge pressure are pension funds. And again, a lot of insurers are, pension funds as well as asset managers. So, overlay over overlay, complex markets. But the thought process now going into the voice of the citizen, and the citizen as a driver for change is a big theme. So that's a very interesting dynamic. The intergenerational change we are seeing in the lack of trust in the financial community, in the institutional community to protect our wealth, has been something that's been going on for the last decade, since the financial crisis, since most central banks had to bail out their incumbent private market banks. And so where the current younger generations, or even, existing generations decide to put their discretionary capital in short, mid, or long-term savings, is a big factor to consider, as well as moving and forcing the change. And it's been proven, because I've been working in this industry, that people are willing to put money into sustainable investments without, the promise of greater returns. Is so long as their money is being put to being put to work, and there is a modest return, people would make that choice. That is definitely in the data. So that's encouraging.
Well, is there still a trade-off? This is one of the things I wanted to talk about really from the get-go. Is there still a trade-off, as I think many people perceive there is, between investing in sort of bad industries where you can make higher returns? So perhaps, oil and gas companies, this is not to slag off various companies, but does it have to be a trade-off? When you go for a sustainable investment, you have to accept you're going to get a lower return. Is that still the case? Is it ever been the case? Do you think it's a sort of misconception?
I don't think it's not a misconception. And I think going back 20 years ago, let's take the energy sector, and we take the kind of rise of alternative energy sources, more sustainable energy sources such as solar and wind. They've required a lot of capital, but actually been insufficient in terms of output and return. And so there's been this period of experimentation with these new market makers actually being able to deliver on the promise. That is changing. And so we are seeing, and there's plenty out there in terms of proof points of how direct investments, so investments in projects that are renewable, sustainable, given the right level of capital, can definitely deliver returns. The issue is these are the very projects that are misunderstood by the broader financial services community. They are under invested in, or they are having to rely on investment from government, which is slow, and is fraught with friction in terms of bureaucracy. So the issue is not so much that these investments are not good investments. The thing that gets in the way is the amount of capital coming into these investments at pace, right? And we don't know, like, I have no idea how long the oil and gas industry took to figure out, all right, how to be profitable. I mean, it's probably a ridiculous retort, but let's be honest, the amount of R&D that goes into the petrochemical industry and has gone for the last century must have cost us, the global economy, trillions. Now, we have to accept that these new market industries, or these new direct investments that are representing much more sustainability, are going to need a period of incubation, but they are vital. And the better the technology gets, the faster they will be able to scale and prove out a return.
So the more investment there is, probably the faster we could get there, where you get a better rate of return. So it's a matter of like scale and the volume of investment, right? In that sense.
Yeah, and dare I say it, the appetite for risk in innovation. Innovation and risk go hand in hand. And it is, for people like you and I, this is so obvious, but the movement away, risk is everywhere. And we can't avoid it. What we have to do is embrace it. And technology is going to mitigate a lot of that risk. So where we're in now is the faster, certainly, that sources of capital can get their heads around technology and the technicalities of the industry, the better, right? And therefore it's a virtuous cycle. They can release more capital into the innovation improves faster, it scales faster, and hey, we get a better return, and we're doing good by society and the environment.
It makes sense. But talking about the actual technologies then that can help, because we've talked about this a little bit.
Yeah.
Are there any, or I guess I would say, which emerging technologies do you see as maybe having the biggest potential at the moment to help promote sustainability or sustainable growth? Are there any particular ones?
Well, I'm certainly not an engineer. Maybe you can tell that quite easily. And I don't have a scientific background. What I do have is a background in financial technology, and what is the art of the possible. So the role of technology in being the not just incumbent technology to go faster and to improve efficiencies. We are talking about the business models that have turned financial product design on its head. We're talking about new ways in which to raise capital, underwrite, provide products and services to improve inclusion. These have come from technology business models. When we talk about the big tech players moving into the payment space, which they have done and are probably, one would argue, owning hands down, you can see, right? You can see how powerful these business models are, and they're all based on the premise of how technology scales, how it lowers cost, how it collapses complex intermediaries or value chains, which is better for everyone. So this is going to be no different. The last bastions of change, certainly from a fintech perspective, were always insurance and asset management, and to a degree wealth management. But as you kind of move towards private capital and retail investors, so you saw more fintech propositions come to light. But now what we're seeing is the structural change needed in these big walls of capital, the big institutional players, which is very interesting to watch, because it's like a huge discomfort for, oh my God, technology, how's it going to be a business model change for me? And so the kind of greening, the structural greening of the financial value chain from institutional asset management through to you and I is a huge job to do. And what's going to be super interesting is seeing, okay, how new market players from a financial services perspective come in and aid that transition, unpick parts of that value chain. So let's give an example. Let's help with that. So one of the big issues we've already discussed is, how does capital understand new investments, right? New investment opportunities in sustainability, whether they've been transportation, logistics, maritime. One of the ways it has to get to grips with this new world is understand climatic data, unstructured data, data coming from oracles or IoT devices or satellites. The financial services community, certainly portfolio construction players or fund managers, have never really had to think about this. Now they really have to think about this, because this is what's going to determine how they develop risk for their portfolios or their underwriting strategies. So there's a big role to play for data analytics, AI providers, quantitative computing. These are big terms, but they actually really are coming to life in this space, as are the ways in which technology can be used to stress test, because we're living in unprecedented times. It's no use looking at risk models of old. We have to learn as we go, right? So this staccato move of the financial services world, the kind of risk assessment, risk modeling world, going, okay, well, we'll build a risk model, we'll test it a bit, and we'll stick with that. We'll stick with that for the next 20 years, right? Ain't going to cut it. Right? The world is evolving. It is a amorphous, changing system, and the risk is coming at us more than we can ever imagine. So the way in which technology can aid this, and fintech technology specifically is really helping the players in the market get much more familiar with experimentation at a faster pace. And the more you model, the more you scenario plan, the more you stress test, the better equipped you are for assessing where the opportunity is and where the risk is. And then, of course, there are many examples of how consumers are beginning to make choices, greener choices, and wanting to go with investments, wanting to save in ways that are linked to being able to trace and track their savings or investment monies to sustainable causes, whether that be direct projects in wind farms, or whether that be saving a forest, or whether that be saving, a corridor within the ocean. These are all, there are plenty of examples of these new kind of crowdfunding retail investment platforms coming to life that actually are really trying to directly look at greener projects.
I guess one of the things that we've talked about a couple of times now, and again, just there, this idea, I think it's common for people to feel perhaps frightened or overwhelmed by change, especially change on the level that we might be talking about here. But one of the things that's coming through is this idea that actually, as citizens and consumers, we can have a direct impact on that change. So is that a message you would send to people, to kind of think you actually have the power as a consumer, as a citizen, to influence the way this develops?
Absolutely. The one way in which this frustration or perceived lack of power has manifested has been the number of protests, right? And we've seen that in London, certainly, right? So that there is certainly, I think, the recognition within consumers that they want to do something. The level of activism, the level of kind of social media activity, taking to the streets, demanding change, predominantly from governments, but also financial institutions, is on the rise. But luckily, now we are in a position where there is, I wouldn't say at the pace I'd like to see it, but certainly the entrance of interesting propositions where actually I can do something. I can actually put my frustration or my desire into action. So I can go to the likes of an Abundance, which is a platform which allows you to invest in green projects. And I can absolutely invest in, a social development housing project or a wind farm. There are the emergence of green banks. So Triodos in the UK, is probably the best example. You've got the attempts at the likes of the Co-op coming up with a Smile banking option, which is really, looking at kind of savings returns linked to community projects. You've got the likes of the Ecology Building Society. You've got green insurance now becoming something that people are getting their heads around, specifically motor insurance, where obviously that's pretty easy to kind of get your head around, I guess. Driving, an electric vehicle, and insurance premiums that incentivize the use of either going slower and in a more moderate way so that your emissions are lower, or buying an electric vehicle. And then, there are a number of other quite surprising but interesting evolutions in the likes of a project called Blossom. Blossom is the first retail sukuk, which is an Islamic finance bond out of Indonesia, which allowed people to invest in infrastructure projects in Indonesia, which was completely
oversubscribed, was it?
Oversubscribed, thank you. And that was, that was a small effort. It was $50 million, but amazing to see the kind of reaction to that. So I think those small examples do give you a sense of the fact that every day there are new projects coming to market, new business models, new investment products, and new financial products driven by innovative thinking, either from newcomers or more progressive incumbents, to address our need to want to change.
Well, let's go back to what you do then at Redsand Ventures. which we mentioned obviously before, but like you kind of build and invest in ventures with the idea they're going to be environmentally sustainable and perhaps have other benefits as well, but also profitable. So what is a venture in this context for people who aren't familiar with how that works, and sort of how does venturing work?
Sure. Well, let me start with that, because I think that's the kind of baseline. So a venture is a business. And through all my years of being involved in product innovation and R&D, one of the most obvious things to me, but it became something very self-fulfilling, was if I was going to put money into creating a roadmap or thinking about the future, the best way for me to get a return on that money would be to test something in the real world, right? And we all are very familiar with, we all own an iPhone, and how many upgrades do we get, a month with these things. So a player like Apple is testing us all the time. But what they've got is they've got a product, right? And once we're hooked into that product, we live with that evolution, all right? This is not a static experience. It changes all the time. So I certainly got to understand the value of taking a product to market and testing it with real customers, and surprisingly how elastic and embracing consumers were, how much they would tolerate with a product evolving. So when we look at fintech and we look at ventures, generally speaking, what happened, with the first surge of fintech 10 or so years ago was there was the fintech community, and there were all these entrepreneurs coming to market with great ideas. And then you had the institutions trying to figure out, oh, okay, so does this innovation, do we just watch them? Do we invest in them? What do we do inside? How do we get some of that, fairy dust to actually affect us? And how do we become cooler and more relevant? Well, it was never going to be a theoretical exercise. You would have to get into the market and experience the customer's reaction. So what happened with Redsand is we became that conduit. We became the partner to create businesses, to create ventures. They weren't, obviously sizable, but we would incubate an idea, we'd form a team, and we'd get to market on behalf of a mandate. We also took our own measurement one step further, and that was we were super interested in innovation. We sought a ton of innovation as we were evaluating what the market wanted. And so we wanted to ensure that whatever we launched was not only discrete from what was out there, but investable. So over time, what that meant was our clients, who were banks or insurers or asset managers, got to a very tangible position where they actually had a company, they had a startup, right? Which meant that they had a minimal viable business, not just a minimal viable product. They potentially had, something that was going to could be spun off or form the anchor of a new business line. And guess what? There was external validation of the investment community saying, we like this, right? We'd like to invest or co-invest alongside you. So that is what we define as a venture studio, as venture building. It is, for me, and I'm happy to be proven wrong, but I've never been proven wrong as far as I know, the best use of investment dollars, right? So we continue to do that. But with venture building, it's a very long, it is a longer commitment than one may want to engage in. So we also have a product studio, which means we basically render the light products, MVPs, rather than MVBs. We render light products, and that can be something we continue to service, or it is basically handed over to clients. And of course, we are super interested in innovation. So we have placed direct investments in innovations, in fintech innovation. And all of those components are very harmonious. You can see, hopefully I've described the way in which it's a virtuous circle in being able to build, explore, redesign, experiment. That is all part of our value, because if we're, thinking about the crystal ball, we have to be as porous as we can. So we represent that roadmap, that road into the future, by being able to execute in an agile way, in a speedy way, but in a quality way. And so hopefully that gives you a grounding of what we do and what ventures actually mean.
So your clients tend to be big corporate companies, or is it a mix?
It is. I mean, it's a mixture of corporates in that, I mean, larger organizations that feel they either need to digitize or move, look into that crystal ball and do something quite radical to reinvent. And a lot of our bias has been financial institutions, but not exclusively. I mean, our conversation today has probably offered up examples of how the transitional industries are the exact type of companies. If they're going to radically shift and move fast enough to adhere to changing regulation or new technical options or digitization options, we've worked with construction companies and energy companies as well.
So when you're looking at building something, building a minimum viable business, is this something where you might work with certain technology experts, or might you work with certain startups, or how does that work?
Oh, okay. Yeah. I mean, it's a very good question. And I missed that bit out. It is a process. So essentially what you do is, when you're looking at, like, thinking about launching any business, right? You do your market research. You go out and you discover what exists. What can you learn from? What can you test? So that absolutely is the starting point. And sometimes that's where you stop, because you think, hell, there's a ton load out there. I'm just going to basically be one of many if I try and do this. Or hold on a second, that process of discovery has actually shone the light on another, even more interesting opportunity. So that's the first place you start. So it's really research, bringing in industry experts, bringing academia, certainly in the world of sustainability. A lot of the art of the possible is sitting in the minds of academia right now, because a lot of it is quite technical knowledge. We then land on the framework for a business model, and it is our job to basically engineer a full service operation. So by that, I mean, we're not just theorists. We bring a team together, and that team is an operational team. So we have technology, we have creative, brand, content, legal. Very often within the fintech realm, there is some kind of licensing or regulation to adhere to. And though that team then works as a cluster with an identity to a point where we can start testing the market. Once we get, and this is iterative, I mean, we test all the time, but prior to market launch, we then start looking at how we industrialize this entity. Is this entity going to be a business line? Does it mean that our custodian or the corporation that the mandate came from has capability it'd like to transition and run this business? Do we need to hire new people? Do we need to pull our people away? And dare I say, Damien, sometimes, and it's been not uncommon, our teams have transitioned with businesses. They've made the choice to actually stay with this new exciting venture. So we bring all of that to life. That is really true incubation. It is not a theoretical exercise. We have to bring all the competencies together, because if we're standing in front of investors and we have to validate that we have a going concern, we have to be able to prove that this is going to make money, that it is something the market wants, the product market fit is there, and we can execute on it.
So it sounds like there's a lot of opportunity here. Like, say, I'm thinking in the context of, say, the impact of COVID, lockdown, etc., that for people who might be coming to the end of their studies or might be looking to enter the jobs market in soon, it might feel like it's going to be incredibly difficult, but this seems like there's potentially a lot of opportunity for people here. What kind of advice would you give to people who might be either starting their careers or looking to maybe change careers if they're a bit further on? What advice might you give to them and how they could maybe get involved in this area?
Well, I mean, I can imagine there is a lot of fear and concern. We are going through arguably the biggest transition humanity's ever seen in a very short period of time, right? I mean, certainly in 5 lifetimes, like 5 generations. So the models of old are being severely tested, including academic models of old, right? So my first point is, if you've been studying and the job market appears to be somewhat closed to you, that has got very little to do with you and your capability. All right. There are a number of forces coming to play that are challenging the very market that you're trying to enter. But with every challenge is an opportunity. And look, not everyone is designed to be, top to bottom entrepreneurial in their thinking. The world would be crazy if they were just like full of entrepreneurs. But I do think there is a mindset shift that's needing to take place with people to think about the pride they can have in demonstrating their own micro entrepreneurship value to a market. I think the world would be a lot better, whether you work for a corporation or whether you really want to drive your own agenda and start your own business, really thinking about the freedom to be creative as a start, and demanding that freedom, all right, within the environment you're in is so important, because that's how problems get solved. Group thinking has got us so far. One would argue it's not going to get us too far, right? beyond 2020, very radical thinking is required. So my practical advice would be to be incredibly open as to where you land, but take with you the fact that you are going to find the world you're in changing, right, at every level, and to use that to advantage to develop your own agility. So that's, fairly philosophical, probably not as pragmatic as people would want to say, is like, go to this website and there's a number of jobs out there. I can't offer that. What I can say is, yes, there is, in this transition, which I believe is going to be far more accelerated and needs to be far more accelerated than ever, there is going to be the opportunity for people with voices and ideas to come forward, right? And if you just take the financial services community, the level of education that is required, and the level of experimentation, I believe, that is required is, it is phenomenal. So why not go for that? I'm personally involved in a youth empowerment project. I can't say too much about it, but I'm super interested in basically fostering the future generations as being entrepreneurs. I'm working on a project that's looking at climate finance and the future of banking and how every future banker should be an entrepreneur. So therein lies, background was seen as super cool because finance didn't understand technology. I think the next 10 years will be a situation where financial services will need entrepreneurs, all right, as many as it can get hold of, to test its thinking and to evolve business models at the pace it needs to. So hopefully that's of some help, and just keep positive, because we need to go through this, and the only way to get to the end is to go through. So, resilience is a big quality as well.
Oh, resilience. Yeah. Yeah, definitely. We teased this a little while ago. I think we haven't really talked this out, but about the role of private equity in all this, how is that distinct then from, say, the role of the big financial institutions and public companies? What role does private equity have to play in all this?
Look, private equity means many things, but it is, for those of your listeners who are less familiar with the world of private equity, you would have heard the term, and you would have heard the term venture capital, and that conjures up some ideas, perhaps more Hollywood ideas than, than anything else. But really, it is the source of capital that is less structured and governed by the scrutiny of big regulated markets, more institutional capital. So public markets are really the domain of listed companies, stock markets, where corporations of a certain size list, and the world of capital markets and listed entities is one aspect of capital raising. Then there's this world of private equity, which is, I wouldn't say a tier down, but addresses a whole different need, and that is where newer businesses and growth businesses source capital from. So that I'm not talking about going to a bank or going to a debt provider and getting a loan. I'm talking about investment, equity investment, where individuals or companies take a stake within your business and buy into a vision, and buy into your ability to execute on that vision. So there is often less need, or there is no ability to pay a coupon or an interest rate because you haven't built your business yet. So the only way to get capital is get someone to believe in your vision. Now, that is an incredibly important role to play, and has always had an important role to play. The issue, because of what I've described with private equity and venture capital, is the way in which it's designed is it is high risk, because people say, well, okay, if I'm an investor in private equity, of which, many an institutional investor is, it's a high risk category because you're investing in businesses that are still on their growth spurt and anything could happen to them, especially look at this pandemic. I mean, how many young businesses are going to survive? So my money's at risk. So what happens is that money generally is tied up in a vehicle, in a fund, for a fairly long time with no repayment, right? No investment return. And investors in private equity accept that. It's like, okay, I'm going to make that allocation. I'm going to sit on my hands for 10 years. And whatever you do in that little black box of yours, just give me a good return, right? Because I'm risking on you. The issue is that the cascade effect of fund management and private equity, not pervasively, but to a large degree, has been an excuse, so to speak, to build portfolios of companies where the margins to operate those portfolios are razor thin, right? There's very little buffer for the fund managers and GP practices, or essentially investors that run these funds in private equity, to actually give too much to the portfolio companies. And what they do is they essentially bet on one or two unicorns, right? And the rest, like, whatever, right? Now, you can understand why that's happened. And there's been some amazing companies that have come out of venture capital, and, venture capital is many things and it looks very different around the world. But the dark side of that is there's very little transparency. And when you look at impact and impact investing and these newer business models that are coming to market, there is so much that is needed in terms of transparency, because how do you know what these companies are doing, right? So the same governance and scrutiny that's going into capital markets, i.e. the allocation of capital and the monitoring of capital, needs to apply to the investee companies in private markets, because they're the ones that are actually potentially going to be the big game changers, these new market makers. And yet in the current structures, they just bundle together, and the fund managers hoping for a home run and one or two companies to make him or her their money. So the nature of private equity is needing to change. It's going to need to be a lot more patient, not just in terms of timing, but how it nurtures and feeds its portfolio, how it brings knowledge to its portfolio, how it brings transparency. I would expect that there'll be new frameworks and new governance being placed into private market capital allocation to make it much more porous and visible. And that will change the nature of this space, I believe. So I talk about sustainable venture capital, and those are some of the signals that I certainly would like to see in what's needed.
But do you see any sign of this happening already, or is this something you think it just, like, there's not enough of it at the moment? Like, do you see that change starting to happen, I guess?
In pockets. Where it's coming from is it's coming from, if you just take the UK, for example, or Europe, a lot of the impact investing from a venture capital perspective is coming from public monies. So it's coming from development banks. So these new venture capital firms that are setting up represent the transition from quasi-like NGOs through to, commercial enterprises in terms of capital allocators. And along with that transition, there is this heritage of governance, because this is public money. The development bank is giving, the British Business Bank, right, is one port of call for many new fund managers to go to get their first anchor investor. If your anchor investor is a development bank, you better believe that you have to tick a lot of boxes and answer a lot of questions and be beholden to a lot of scrutiny. So that is one. I'm not saying there's pain with that, but that's one way in which you're seeing the impact investment philosophy filter through into venture capital, because not all venture capital is impact centric or in its ethics or philosophy. So that is happening. And I think, certainly Europe is probably going to, dare I say, lead the way on this, just because of the way in which we are, again, much more mature around regulation, taxonomies, thinking in terms of sustainability and impact. Switzerland houses more impact investors than any other country in the world. The top 10 impact investors are all Swiss. So you'd expect that to trickle through into private market players such as private equity and venture capital.
But just one thing there, is there any risk that this need for regulation to help drive this change might inadvertently pose some barriers to innovation in some ways down the line?
There are always barriers to innovation. There have been, always. Regulation is, on the surface, this kind of like counter current to innovation, because it's rules and it's like risk aversion. But actually, the one thing that fintech has achieved, I would say, is the merging together of regulation and innovation. And so it's, most countries, most jurisdictions, whether it be within the actual financial regulator itself or the central bank, have what they call kind of sand pits. Our regulator has, almost every jurisdiction does. So regulators have got their heads around the fact that they may not be, regulation always follows a market, right? They kind of let the market run, and then they go, oh, okay, there's consumer protection required here, or systemic risk on its way. We better kick in with control. So what happened with fintech was, at least one could argue that the regulation began to straddle. It got involved with the innovation. It got to guide innovation and entrepreneurs along their journey. So I think, hopefully, in the world of sustainable finance and what fintech means in this world, or green fintech means in this world, there is a comfort factor for policymakers to actually look at innovation in a very different way, because they know it's needed. It's needed as the catalyst for the structural change that they're more worried about, which is big, traditional incumbents not moving fast enough. So it's a really interesting time. I think it's a coming of age for fintech, really. It struggled to be, it struggled by being on the periphery for the last decade of really trying to kind of, disrupt. Well, it hasn't really disrupted. But now what we're seeing is actually the big tech, the deep tech is needed. These business models, this thinking, these real change agents are needed to actually aid the industries that are needing to transition and those that underwrite and allocate capital to transition at the pace required to basically, keep us going on this planet.
Well, last question then, thinking about all of this, anyone who wants to find out more information, would you recommend, we have mentioned some very interesting things already, would you recommend any particular websites or authors or thinkers that you think people might follow? I think like say a top 3, top 5, perhaps, to make it easier. And I can put links in the box below for anyone who's interested then to find out more. Who would be your top people you might recommend, or top institutions, perhaps?
Yeah, I mean, totally, the UN is first port of call, right? Certainly looking at I think there's no short of about 10 to 15 major UN enabled groups around sustainable finance that are super interesting, and that's a big kind of port of call, right, to look at where the thinking, both the academic community and the policymaking community are putting their heads around. Then I would say there is, for those who are interested in the kind of structural change that's needed, certainly in the asset management industry, there is an association called the Green Digital Finance Alliance, which is again a UN sponsored initiative, but actually it's an NGO, but part sponsored by Ant Financial out of China. Sounds like a strange combination, but they're doing some very interesting research around specifically fintech and green fintech. I would recommend, for those of you who are particularly interested in biodiversity and what that means to the what that means to finance and how could that aid the transition of finance. There's a very new report that's come out, in fact, just in the last 2 weeks, called the Des Gupta report, which looks specifically at the role of biodiversity as influencing finance, and how we build better, greener, and protecting our biosphere. Super interesting, really academic paper, but very, 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 very interesting stuff in there. And then, gosh, I think certainly looking at players such as the fantastic work that, I would say this because I'm on the advisory board, but certainly the fantastic work that Finextra is doing. Many of you will be familiar with Finextra, just in terms of consumable, up-to-date news articles. They have a sustainable finance track. I'm not involved with Finextra, let's make it clear, but they do have a particular stream dedicated to the technology opportunity that sustainable finance is offering. And, that is important, that, that's live feeds coming through every single day. So those are just some of the places I'd go to. Individuals, hard to say, really. I think we are really on the precipice of some true individual thought leadership coming through. I think for those that had potentially a viewpoint as individuals, maybe rethinking that viewpoint in 2020. So I'll hold off on recommending specific individual thought leaderships on this particular topic right now.
Okay, cool. Well, this has been a fascinating conversation. Thank you very much for your time, Nicole. Yeah, what are you going to be up to next? What's your next big kind of project?
Well, I'm I'm constantly looking at myself, the capital allocation challenge that I have for innovation. So in simpler terms, fundraising. That's keeping me very, very busy. And that's a whole different topic. And just, keeping a watchful eye out in terms of what innovation's coming through. The other area that I'm working on is actually looking at the provision of infrastructure as a service. So basically creating my own service arm to aid stress testing, cloud infrastructure, enterprise rigor level cloud infrastructure to aid scenario planning and stress testing for institutional clients. So pretty busy time.
Lots to do. Cool. Well, I will also put a link to the Redsand Ventures website as well down in the box, so people can check out what you're up to and check out the blogs and things you've got on there. Well, and thanks again for your time, Nicole. It's been great.
Thank you so much, Damon. Great to speak.
If you made it to the end of this video, leave a comment or a question below. I'd love to know what you think about some of the topics we've discussed here today. If you enjoyed the video, please consider liking and sharing it, and do subscribe to the channel if you want to stay up to date with all my videos as they go live. Thank you so much for watching, and stay curious.